Bitnile, or Nile, has been trending in popularity recently, and a lot of people are wondering if they should be buying more, selling what they have, or just standing on the side to wait for better timing. As the market is still very volatile at the moment, we should be careful about which stocks to pick and what would be the exposure and the timing of the positions we are taking. Over the past few days, the price action of NILE, or Bitnile, has brought the stock to 63 cents before stabilizing around 55 cents. The short-term price trend of Bitnile has been bearish. The market has been hesitant to send the stock at a higher place, and we should be looking at a phase of regrouping and then a pickup of volatility soon afterwards. I think that the current price action is not going to last, and the market has to make a call fairly soon. When we look at the long-term price trend of Bitnile, it has been bearish overall. The company's own operations, the current market narrative, and the issues that it is focusing on are likely the main reasons why the capital is not being put in the stock, and we should see the situation of Bitnile a bit like a continuation of the market as a whole. We often tend to think that the individual stocks have their own stories and often overlook the collective tendency to go to the same path. Now, let's also have a look at the technicals of the stock. The trading volume of Bitnile has recently been 30 million shares versus the average volume of 67 million shares. Over the previous 52-week period, its price has fluctuated between 50 cents and $3.70. The market cap of Bitnile is currently at $50 million versus the enterprise value of $84 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to grow more rapidly than its rivals, because it may have a better management team, a stronger brand recognition, or a bigger online following. It is what makes this company unique compared to its competitors. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the enterprise value is less reactive than the market cap in very volatile situations. If the company goes to liquidation, the goodwill would be completely gone, and the stakeholders would be left with far less assets than whatever that is written on the balance sheet at the moment. When we compare the current price to the historical price fluctuations, the stock is 10% higher than the 1-month low, 10% higher than the 3-month low, and 10% higher than the 52-week low. On the options market, which often gives us a hint about where the stock price is likely going to go next, the implied volatility is 333% versus a historical volatility of 173%. The put-call volume ratio is currently at 0.01. It is normal for many stocks to have a higher put option than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 7,000 contracts a day versus the 30-day average of 14,000. In terms of open interest, the most recent volume of open interest is 180,000 contracts versus the 30-day average of 105,000 contracts. In terms of shareholder structure, institutional shareholders own about 15% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Renaissance. It is relevant to understand the shareholder composition of a company, as it often helps to determine if you should be holding the stock long-term or to view it as a trade opportunity in the short term. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. This is obviously subject to a lot of exceptions, as many great companies are also mostly held by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this can be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 12% of the total float, and 53% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of the short volume coming out of the dark pools, this is a suggestion that institutional positions have taken a short stance against the stock, and that there would be potentials for a short squeeze. Now, having said on this, my overall recommendation is to have a position in Nile, and to make sure that you have enough allocation room for later purchases if the stock ever goes lower. In this case, I actually recommend to hold for a fairly decent amount of time with a small position so that you can benefit from the uptick of the market later. I think that Bitnile is going to have a pickup in volatility as we go forward, and that we should be ready for the share price to swing both ways by having a position along with enough allocation for later. I would recommend to commit between 1 to 3% of your portfolio in the stock. And I would also recommend to split your allocation in batches of 20% at a time so that you can purchase more if it ever retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.